3 companies gained $1.5 trillion of market value in a single week. 4 trading days later, somebody published the price of the thing they sell, and it was 100 times lower than the frontier charges. This is a story about the difference between demand and revenue, and almost nobody is telling it because the first half was so much fun. We'll start with the week that made everyone happy, because the numbers were genuinely spectacular. Amazon Web Services did $42.2 billion in the quarter, up 37% year-over-year. That is its fastest growth in 18 quarters, and it beat what analysts expected by nearly $2 billion. Operating income hit $16.6 billion at a 39.4% margin. Amazon's total revenue crossed $200 billion in a single quarter for the first time in the company's history. Microsoft ran up 16% on the week. Amazon ran up 10%. And together with Alphabet, those three added something close to $1.5 trillion in 5 trading days. The thesis behind it was clean, and honestly, it was correct. Artificial intelligence had stopped being a research demo and started showing up as cloud revenue you could audit. Then came the pylon, and it was unusually unanimous. 4 hyperscalers, one message: the artificial intelligence trade is not a bubble, it's a business. Inference demand is durable. The capital spending is justified. You could read that take in 50 different places by Friday afternoon, and every one of them had the same shape. Demand is real, therefore the spending is fine, therefore the stocks are cheap. It sounded like a conclusion. It was actually 3 separate claims stacked on top of each other, and only the first one had evidence. Except, this morning, a research firm called Artificial Analysis published something the earnings calls never mention: not how much artificial intelligence people are buying, what it actually costs to run. 3 cents versus $3.15. Same task. DeepSeek's new V4-Flash model runs at about 3 cents per completed job. Anthropic's Claude Fable 5 costs $3.15 to do the same work. OpenAI's GPT-5.6 Sol sits in between, at $1.86. And the methodology here is the part that makes it serious. Artificial analysis does not compare sticker prices per token, which are easy to game. It measures the average cost of finishing an actual test, which captures how much the model has to read and write before it's done. On that measure, the cheapest capable model on the market runs at more than 100 times below the frontier. Now let me be scrupulously fair here, because this is where a lot of commentary today got sloppy. Cheapest to operate is not the same as best. This is a cost result. It is not a capability result. Nobody serious is claiming these models are equivalent on the hardest problems, and if your work genuinely needs the frontier, you are going to keep paying for the frontier. But here is the uncomfortable part. Most commercial artificial intelligence work is not the hardest work. It's summarizing, classifying, extracting, drafting, answering the same 11 customer questions forever. That is the ordinary middle of the market, and it is enormous. And in the ordinary middle, a 100-fold cost gap doesn't win an argument. It wins the contract, and it doesn't need a rematch. Here's the mechanism everybody is skipping, and it has nothing to do with who has the smartest model. A hyperscaler's artificial intelligence business is a spread trade stretched across time. You spend the money now, you build the data center now, you buy the chips now, and then you don't expense any of that immediately. You capitalize it, and you depreciate it over 5 or 6 years against the revenue you expect it to produce over that life, which means the useful life assumption sitting in those financial statements is not really an accounting choice. It is a forecast. It is a bet on what a unit of artificial intelligence output will be worth in 2030 and 2031. And that forecast was made when the frontier charged frontier prices. The asset was underwritten against the old cost curve. The curve just moved, and depreciation schedules do not reprice as fast as software does. If this feels familiar, it should, because it is one of the oldest patterns in capital markets. Railroads, fiber optic cable, airlines, memory chips, every single time the same 3-act structure. Demand for the thing turns out to be even bigger than the optimists said. The cost of providing it collapses faster than anyone modeled, and the people who finance the old cost curve get destroyed while the people who build on top of the new one get rich. 1990s fiber is the cleanest version. Internet traffic did explode, exactly as promised. And the companies that laid the cable went bankrupt anyway because the price per bit fell faster than the volume grew. Being right about demand did not save them. It was never the variable that mattered. Now the honest risk to my own argument, because I'd rather you hear it from me. Cheaper units can absolutely produce more total revenue. That's the Jevons case, and it is a real thing, not a cope. If the price falls 100 times and the volume rises 300 times, the hyperscalers are fine, and I'm wrong. Amazon Web Services growing 37% is genuine evidence in that direction, and I'm not going to pretend otherwise. There's a second one too. These companies do not only rent raw compute. They sell the security, the compliance, the data residency, the integration, the enterprise contract. Plenty of large customers will pay a premium to never think about where the model is hosted, and that premium is defensible, so the bear case is not automatic. What it is unpriced, and there's a small tell that the sellers know it. Alibaba shipped Quen 3.8 Max the same day. 2.4 trillion parameters, a million token context window, and it published no per token price at all. When a company launches its biggest model and holds back the price is the part still under negotiation. Here's the read, and here's the falsifiable call that goes with it. The read is that the market spent last week paying $1.5 trillion for evidence about demand, and demand was never the uncertain part. The uncertain part is price. And the first hard data point on price landed 4 days later and pointed straight down. That gap between what got paid for and what got measured is the whole opportunity, whichever side of it you end up on. And here's the call. You can grade me on it. Before the 31st of December, 2026, at least one American frontier lab, Anthropic or OpenAI, either cuts published per token pricing on a flagship model or introduces a materially cheaper flagship tier. That's it. That's the test. Go and look at the published price sheets on New Year's Eve and mark it right or wrong. If frontier pricing holds all the way through December, the mode is real and I was too early. If it breaks, then the cost floor moved, and everything financed against the old one has some arithmetic to redo. This week, the market paid $1.5 trillion for the demand. Somebody still has to pay for the deflation. If you want the full picture of today's tape, the manufacturing divergence and the currency intervention nobody covered, today's daily brief is linked below. I'm Frankie, the asymmetric signal, one contrarian read a day. Subscribe. Research and education only, never investment advice.